all, this is Market Explainer. My name is Danny. I am joined always by the junior co-host, this guy, my good friend, the big man. We are America's #1 business news podcast. Well, we're going to talk about a few stories, but before we do that, I want to tell everybody about our Patreon. You can go to patreon.com/Market Explainer, and you can join one of our tiers, and we're going to be throwing up some new shows, some different content, a lot of it in the vein of what we do here at Market Explainer, some of it in the vein of how we started making content together, which is movie reviews. We're going to do 1 or 2 of those.
Sweet.
Yeah, it's just a place for us, doing it on Patreon versus doing it on our traditional channels gives us a little more flexibility, a little more opportunity, because the minute we start posting things with copywritten content where everyone's going to start having a conniption. We can say certain words. We can't say Dos Equis on ours. So, we've done a couple of those episodes here and there as a test. We like them. And now we have a place for those to live. That's over on patreon.com/Market Explainer.
You can also get there from marketexplainer.com, which includes all of our episodes, our Patreon, links to everything that you need at marketexplainer.com.
That's right. And we also have links to all of our sponsors, many of which I own. So, how many does the big man own, you ask? 1. So, listen.
Go ahead, Danny.
Occasionally, I like to talk about the stock market. I had been out of the market as an investor for some time. Just this morning, jumped back in. So there's going to be a huge rush of IPOs coming this fall. And I just want to point out before everybody goes public that this has never failed before, right?
Okay, all right. Don't start with your crap. Don't start with your negative Nancy.
I'm not
the
being
whole
negative
world's
Nancy.
going to explode.
No, that's not what
Everything's going to crash. Everything.
Okay. One of the expected IPOs, I don't know if it's covered in this article, I can't remember, but one of them is our good friends over at Rivian. I know they're trying to go public this fall and in the spring. And I say good friends, we hang out all the time. I'm on their board.
No.
Well, I identify as being on their board.
Let's back up for a second. Let's tell everybody what the actual story is. The story is already in this year, it's been one of the busiest years for both IPOs and SPACs, in history. If that trajectory continues for the rest of the year, which they believe it will become the highest IPO SPAC year in history. What Danny was alluding to, in that this has never happened before and it can't fail, is the last time that we got even close to these numbers, the second highest, or currently the highest, was the .com
2000.
In 2000, the .com, what we now call the .com bubble, right? Yeah. The .com burst. So that's what he's referring to. So that's really the story we're talking about here. But this is different than it was in 2000. And let me explain to you why before we get into some of these, like he brings up Rivian and stuff like that. Right. Most of the companies, not all, but most of the companies back in 2000, the .com eras, these were companies that did nothing for no one. At the best, they were software companies that were supposed to build a product for someone else that was eventually going to solve a problem, right? And everybody was making so much money as investors that the common person jumped into the market thinking, I can throw money at anything and it's going to make me rich. It's going to make me a return. So they ended up investing in things that led to nothing. So the only people that made money were the people that owned those companies that initially offered those, right? And then they maintained being rich while the investors got nothing when the bubble burst.
So to quote Dave Portnoy, Prez, stocks only go up, baby. That's not true. They come down sometimes. I think we've seen unprecedented market liquidity from the Federal Reserve, which sometimes contributes to that feeling of everything going up in price. It's also called inflation.
Well,
by some people,
but
some
here's
economists.
what's different now. These companies that have gone IPO this year, these companies that have gone SPACs this year, by and large, not all. We've talked about several of them on this podcast. That
Correct.
But by and large, are companies that offer a product. These companies have been around for a couple of years, or they've done something specific that they a lot of them make money. And here's what's a little different in this year, and this is part of this story. This year, even though we've had so many IPOs and they're making money, what I consider a flag I guess it would be a green flag, not a red flag to me, is most of your IPOs this year have actually underperformed. Meaning that they have closed the first day or within that first week at less than they initially went IPO.
Right, which you would think that would be a signal to people trying to go public, be a SPAC or IPO. It would be a signal to them to have some pause. But the reason that I think a lot of these, in the article, let's just talk about a couple of these names here, right?
Mm-hmm.
Warby Parker, Fresh Market, I'm unfamiliar with them. Authentic Brands, I know they are. Nautica, Eddie Bauer, that kind of thing.
Yeah.
Allbirds. Right? These are just a few of the companies. Instacart, Sweet
You know
Green.
who Instacart is.
Of
Everybody
course.
knows Chobani, whatever it is for Greek yogurt.
Fantastic
You've
yogurt.
seen it in your community.
Impossible Foods.
Right,
So-
which everybody knows from the Impossible Burger, right?
Yes.
What is it? Burger King?
The
Right, the Impossible
Whopper.
Burger and stuff like that.
Yeah.
So most of these are actually pretty big names. That's what I'm talking about.
Right.
These are
and so-
actual companies.
Right. And so if you look at them, though, most of these, if not all of them, have another common thread, and that is Silicon Valley venture capital, right?
Sure.
So a lot of these companies they have huge investment from, I don't know but I can just throw out some names and probably be correct. Andreessen Horowitz, Sequoia. I don't think that, Masayoshi Son is anywhere on here. But I'm just saying that if you look, it's billionaires playing with money from exits that from companies from the 90s, from the last boom. Okay, this is so the connection I'm trying to draw here is a lot of these venture capital funds made their bones going public in 2000 with companies that they boomed
that's
out.
how they get their money back, right?
That's
I
how
get
they get their
venture
money back.
capital of these companies, they go IPO, I get all of my money back, right?
Plus
and
them,
give it to
plus
the
them.
next and give
But
it to
came
the
back
next
with
person
friends.
and whatever. But you've got companies like Stripe, like online payment processing, right?
Which I use.
I mean, again, that's my point. Is you've got companies that are actual companies going on the market versus 2000, right? Now you're talking about, like, if you really look at these numbers, I mean, how many days are in a year? 365, right?
Something like that.
365 days in a year. If we keep on track, just the ones that we know about, you're talking about 375 IPOs alone this year.
Coming in the fall or this year total?
No. That would, if everything that people that have already filed for an IPO, right? Whatever. The estimation is 375 total in 2021. That's more than one a day of the calendar year. When you break that down into actual stock market trading days, it comes out to like 2 a day, which is insane, right?
Which is
that
nuts.
many companies would be.
And I think what we were both alluding to, but not saying, and this isn't a political statement, but this is a method for the initial investors to liquidate their positions, to make good on their investments, sometimes to the chagrin of Main Street, right? Sometimes to the detriment of Main Street. Now, that being said, I know a handful of day traders who are all retired guys, actually, who are doing great, right? This market has been treating them very well. And they're looking at some of these IPOs saying, hey, I'm going to pick up a couple of points here when Warby Parker goes public, right?
Right.
So
Well, you've seen this trend. We said earlier that a lot of IPOs were trading downward day one. Again, by I'm the resident stock guy. You know what I mean? Between Danny and I, and we talk about this, or I've talked about it a lot on this podcast, that these valuations, and Danny and I have talked about these valuations, are insane, right? And people are picking up these initial stock offerings, and then your knowledge investors start flooding in at rates that are more reasonable to what the company is supposed to, and it drags that price down, right? Because they can't sell it for the inflated price after the initial, and it drags that first day, that first week, that first month down to a more realistic valuation, and your initial investors see that. Now, long term is different, right? But your initial investors see that, and what it's done, just like the housing market, when you have things for selling less than what you want to sell it for, it drags down the whole market. So what you've seen here recently is IPOs have more realistic valuations, which means their first day, their first week, their first month looks better because they were more realistic with that initial day offering, right? And if that trend continues, then those day traders will make that point quicker, right? Where I know a lot of day traders that are staying away from initial IPOs. They're in 2 or 3 or 4 days because of that drawback, and they know, give it a month, give it or whatever, it's going to go back up to that. They're going to gain that point. They're going to gain that whatever, but they want that initial pullback because that's been the trend this year.
Yeah, and to just to get back to the one thing I was saying, Rivian expects to go public probably in 2022, not this year. And they're going at they're trying to go at an $80 billion value, and that's what happens when you take billions of dollars from Amazon and Ford and other companies. I just want to harp on this for 1 second. I just want to complain. Can I just complain?
Absolutely. Go ahead.
You haven't built anything. I can't go anywhere and buy a Rivian truck. Okay? What?
Well, didn't Jeff Bezos drive one to his penis rocket that he shot into the... Didn't he drive one out to that in his Texas hat? And
That is not a Texas hat, my friend. That is a different kind of hat.
Whatever, I'm just saying.
That was a hat for a guy who drives an electric pickup truck. That's what that hat was.
Exactly.
So a lot of these, like the big man said, a lot of these valuations have become a little more realistic, but we're still living in a world where some of these companies haven't crossed profitability yet, and they're going to the IPO route because I'm saying on their behalf, they're thinking profitability may never come. It could be 5 years away from now. But the investors of these companies, and again, I'm a free market guy, okay, to the
right.
But what we're seeing is companies realizing that the frenzy to invest on the stock market, the FOMO, the fear of missing out, is so strong on the consumer investor side. And I, as a free market guy, do not blame these companies for going public when there is a frenzy to invest on the market, simply because I don't blame them for trying to make money, because that's their job.
Right. But there's a difference between, like Rivian, I believe, in my humble opinion, that they want to go public, especially at a valuation that size, $80 billion, because they need that money to eventually become a profitable company. They need that influx, because you can only convince a certain number of venture capitalists to give you money before they start thinking. You can only go so many rounds before people stop giving you money, before they stop believing you, yada yada. And then what's your next offering? Your average Joe, right? Investor and this kind of stuff. So there's a difference between that and like a Stripe, for example, that has a framework of a company. They're profitable. They make money. It's a framework that's worked for all of our credit card processors in the world. And this is the part of investing that people don't take the time to learn, right?
Right.
You got 375 IPOs in 2021, and there's going to be a percentage of them that are 100% garbage that nobody ever should invest in.
Right.
And there's going to be some of them that make a lot of money, but in that everybody's trying to hit that home run. See, this is the part that scares me. And this is, Danny doesn't care about this part where I think about it, is because Danny believes in that free market. And if you're dumb enough, Danny believes that if you're dumb enough to invest in a dumb investment and you end up getting $0 and losing all your money, then that's on you. Too bad, so sad. Nobody gives a crap. Where
it's not that nobody gives a crap. It's that you learned a lesson and that's all you're going to get for your money. And
I don't know that you learned a lesson.
That might be true, but the point is, some people will spend $3,000 going to a university to take one class and not learn anything. And if you take your $3,000 of capital and invest it and lose it, maybe you learn that you should be investing your money in things you understand and not in things you don't understand. And if you lose $3,000, suck it.
Investing, like a lot of other things, for some reason we go out and we learn from people we know instead of professionals, right? And I don't know why investing falls into that category like a lot of other things, but we go to that Bob that tells you all the time that he's making money day trading when Bob lives in a trailer or whatever. Right. But then you think Bob's going to give you the advice to become a millionaire, right?
Bob lives in a manufactured home, and he would prefer that you don't call it a trailer.
I'm sorry. I apologize. It's a tiny house. But, like, for example, I'll give you a great example, and Danny's going to hate this example. One of these companies that wants to go IPO before the end of the year is a company called Stronghold Digital Mining, which is a crypto company that mines cryptocurrencies. Right. So you're not investing in cryptocurrency. You're investing in a company that mines crypto company, hoping to be profitable one day with your investment to help them buy the mining equipment, space, blah, blah, blah. This is a company that this is what I say about people that don't understand something, right? Half the people that buy stock in this company, if it does go IPO, will think that they're investing in cryptocurrency when they're not at all. They are buying a company that is investing in cryptocurrency, that company will then in turn 100% benefit if that cryptocurrency, goes up or whatever, right? And this kind of stuff.
You're investing in crypto the slowest way possible if you're buying
absolutely, right? Absolutely. But it will bill itself as an alternative way to invest in cryptocurrency, and they'll have a marketing video that says you're investing in the newest thing.
Super slick.
Oh yeah, and it'll be great, right? As far as they're concerned, and that's the part where I get nervous about, people making videos and they're paid to make these videos. To sell something like that, and then the average person buys it thinking they're going to hit the next home run, the next GameStop, the next whatever, and then they get into it and they lose their shorts when institutional investors are investing in other things. That's one of the first things I wish. Again, I'm going to say this and convey this out there. It's just my opinion. If you're investing in a stock, especially long term, I want to invest in something long term. One of the first things that you should look to find is if institutional investors, these are people that control other people's money, right? Large funds and stuff like that. Are institutional investors purchasing that stock?
Correct.
Because if you're investing someone else's money, you're way more leery about it than if you're just investing yours and risking yours. If institutional investors are staying away from it completely, I'm just saying.
Yeah, I mean, if it's because even in the GameStop situation, Michael Burry was signed Capital Management, which was a huge was an investor, and he's like, well, actually, if you look at their store location, if you because when we initially talked about GameStop, I hadn't done enough investigation to know that he was. And so when I later learned that, and he was talking about that Michael Berry had invested with his money, he was talking about why. Well, that kind of made sense. Like there was the fundamentals of the business actually worked, and each store location was very profitable. They had a back-end wholesale business. A lot of it made sense. So,
dude, institutional investors
will
pay
find
millions of dollars to
data.
pay eggheads to
Yes.
figure out what's going on, right?
Right.
To take advantage of every loophole of knowledge,
correct.
of data, of crunching, of everything. And that's
Everything
why I
that's-
say they
everything that's-
understand they're not right all the time.
No,
They're not.
Of course not.
Nobody is. However, they're going to be more right more often because of
Correct.
the access to information and that kind of stuff.
And listen, I think there's a lot of investors out there that are, they're watching The Big Short or whatever. They saw that movie and they went,
Yeah.
geez, I want to be the guy. But we forget that the smallest player in that movie, which is based on true history, the smallest player in that movie, he was laughed out of the lobby of several firms, was playing with 20 something $million, right? They were an investor of $20 million and was laughed out of the lobby of huge institutional investors. I was talking to someone and he's like, well, I wanted to get into day trading, but these companies, man, they won't let you make any money. I was like, dude, if you're playing with less than $250 million, they don't know that you exist. Okay. They don't, you're not even on their radar when you're dealing with people moving billions of dollars in assets around the table. They're not paying attention to someone like.
Well, and to that, let me kind of draw this back in, and we'll finish up the story. When I take IPOs, which is what we're talking about, we talked about SPACs a little bit, okay, which is over another 400 SPACs this year. So
Gnarly.
375 IPOs, over 400 SPACs, right? By the end of the year is what they're expecting. 700 and something between the two.
Going public, yeah.
Their estimation for 2021, right? For companies that did not, as far as being publicly traded, were not publicly traded as of last year. We will see between the two $250 billion come from the consumer fund. $250 billion will have been raised in 2021 from the masses.
That's more money than Bezos and Gates and Musk have combined, I think, just about. I mean, it's getting close to that number.
$250 billion. Like, that's the amount of money that is out there for the taking just in 2021.
Right.
And by the way, these are all people that think that they're going to make more money than that from that.
Of course. That's why they're doing it.
Right.
So, in closing, I just want to say this: I am going to be taking my deli public. It has 4 employees. Kidding. I'm referring to a story earlier this year of a deli that it was public, and people were trying to ascertain why this thing was worth what it was. I think it was worth $10 million on paper. I think they had less than.
It was all about land, right? It was somewhere in New York or New Jersey or something like that, where it was this old, land that was in the middle of what should be something else. It shouldn't be a deli. It should be a high rise. It should be a whatever. And their idea was, hey, let's leverage that to go IPO, right, or SPAC, and keep our deli in this and not sell it and yada yada. Which I give them all the props in the world for creativity.
Right.
It didn't work out. They still closed. But that's pretty creative, right? I mean, and that wouldn't have been available to them 10 years ago, 20 years ago.
Yeah, it's called the Hometown Deli in New Jersey, and I was incorrect. The Hometown International had $100 million market cap at one point.
For a deli in New Jersey,
which even if what you're saying is true, which let's presume it is, there's no $100 million high rise in New Jersey, bro. There isn't. Okay.
Well, I'm just talking about some whatever they're wanting to do with it, right? You know what I'm saying?
But there's no land in New Jersey that's worth $100 million. I promise you.
It's Jersey, man. Don't they have a bunch of hipsters up there living there now?
No, they all went to Brooklyn by now. No, no, that's going to be a no.
That's going to be an ad now?
Yeah, that's okay.
All right. Well, all I'm saying is there's a lot of money out there, so folks, get yours.
$100 million for this deli.
Yeah.